office and members of the committee. I appreciate the opportunity to testify on recent efforts to stabilize the nation's financial markets and to reduce foreclosures. Conditions in the financial markets have deeply shaken the confidence of people around the world in their financial systems. The events of the past few months are unprecedented, to say the least. The government has taken a number of extraordinary steps to bolster public confidence in the U.S. banking system. The most recent were measures to recapitalize our banks and provide temporary liquidity support to unlock credit markets, especially interbank lending. These moves match similar actions taken in Europe. Working with the Treasury Department and other bank regulators, the FDIC will do whatever it takes to preserve the public's trust in the financial system. Despite the current challenges, the bulk of the U.S. banking industry remains well capitalized, but what we do have is a liquidity problem. This liquidity squeeze was initially caused by uncertainty about the value of mortgage-related assets. Since then, credit concerns have broadened considerably, making banks reluctant to lend to each other and to lend to consumers and businesses. As you know, in concert with the Treasury and the Federal Reserve, we took a number of actions to bolster confidence in the banking system. These included temporarily increasing deposit insurance coverage and providing guarantees to new senior unsecured debt issued by banks, thrifts, and holding companies. The purpose of all these programs is to increase bank lending and minimize the impact of deleveraging on the American economy. As a result of these efforts, the financial system is now more stable and interest rate spreads have narrowed substantially. However, credit remains tight and a serious threat to the economic outlook. Regulators will be watching to make sure these emergency resources are mainly used for their intended purpose, responsible lending to consumers and businesses. In the meantime, we remain focused on the borrower side of the equation. Everyone agrees that more needs to be done for homeowners. We need to prevent unnecessary foreclosures, and we need to modify loans at a much faster pace. Foreclosure prevention is essential to helping find a bottom for home prices, to stabilizing mortgage credit markets, and to restoring economic growth. We all know there's no single solution or bullet, but as foreclosures escalate, we're clearly falling behind the curve. Much more aggressive intervention is needed if we are to curb the damage to our neighborhoods and to the broader economy. Last Friday, we released the details of our plan to help 1.5 million homeowners avoid foreclosure. Our program would require a total of about $24 billion in federal financing. The plan is based on a practical experience in modifying thousands of mortgages at IndyMac Federal Bank. As we've done at IndyMac, we would convert unaffordable mortgages into loans that are sustainable over the long term. The plan would set loan modification standards. Eligible borrowers would get lower interest rates and, in some cases, longer loan terms and principal forbearance to make their monthly payments affordable. To encourage the lending industry to participate, the program would create a loan guarantee program that would absorb up to half the losses if the borrower defaults on the modified loan. While we applaud recent announcements by the GSEs and major servicers to adopt more streamlined approaches to loan modifications along the lines we have employed at IndyMac, the stakes are too high and the time is too short to rely exclusively on voluntary efforts. Moreover, these recent announcements do not reach mortgages held in private label securitizations. We need a national solution for a national problem. We need a fast-track federal program that has the potential to reach all homeowners, regardless of who owns their mortgages. What we're proposing is a major investment program that can yield significant returns by attacking the self-reinforcing cycle of unnecessary foreclosures, placing downward pressure on home prices. Average U.S. home prices have declined by more than 20% from their peak and are still spiraling down. If this program can keep home prices from falling by just 3 percentage points less than would otherwise be the case, over $500 billion would remain in homeowners' pockets. Even a conservative estimate of the wealth effect this could have on consumer spending would exceed $40 billion. It would be a big stimulus for the economy and nearly double our investment. In conclusion, the FDIC is fully engaged in preserving trust and stability in the banking system. The FDIC stands committed to achieving what has been our core mission since we were created 75 years ago in the wake of the Great Depression, protecting depositors and maintaining public confidence in the financial system. Thank you.
Thank you. Before I start my testimony, I want to just put into the